Welcome back. This is Mike with Red Pill Quants. Today we're going to talk about a topic that I feel will fundamentally transform your trading experience. It will make you a better trader because we're going to pop the hood, look at what's going on underneath, and gain a much better understanding of how modern financial markets truly work. Because I see a lot of people who come to the market with either flawed, incomplete, or obsolete understanding of how modern markets work. They rely on candle patterns, they rely on indicators, and quite honestly, that's Mickey Mouse stuff. That's not how you survive as a trader in a modern marketplace. Okay? Tall claims, and I'm going to back it up. So I'm going to push you right into the deep end of the pool. So let's dive right in. What you're seeing here in front of you is the ES, the E-mini futures. It runs against the S&P 500 cash index, right? S&P 500, the SPX, everyone knows it. You can also trade the SPX, of course. That's also a futures contract. It's a really big one. Most of you will probably never trade it because it's super expensive. And if you're a futures trader, odds have it that in most cases you will trade the ES. Now, as a quick disclaimer, this is not going to be a tutorial on how to trade futures, okay? I'm just showing you a futures contract to explain a particular topic, to explain a way of how to look at the market because it's related. And unless you understand how it is related and why this is important, really, really important, you will always approach the market with a flawed or incomplete understanding because you will guess on direction. And honestly, direction is extremely difficult to predict. You can predict trends, you can ride a trend, but on a daily basis, it's extremely difficult to say which way a market will swing. And unless you've traded for a few years, then you might still have this idea that you can just look at a chart and know where it's going to go next. Well, a lot of people have lost a lot of money trading this way. Now, today I'm going to show you a different way, a much better way. And that applies to any market, right? You can trade it on stocks, you can trade it on crypto, you can trade it on Forex, bonds, whatever, what have you, right? So let's dive right in and let's look at this chart right here. You can completely ignore the indicator because that one right now doesn't really matter. What matters is this chart and these lines. So we have a normal chart here. It's a futures contract, okay? And these lines, they also have a little code on top if you look at this right here. And it's kind of hard to read on this chart because of my crazy color scheme. So I'm going to go over to the trade tab and I'm going to move my head a little bit. And you're going to see, well, I hope you can read this. And you see these contracts here. So these are futures contracts. And they also, maybe I can drag this a little bit. No, I can't. That's kind of weird, the interface. It's a little bit limited. So you see these futures contracts right here, right? And there are codes there, right? And I'm going to show you these codes because I kind of prepared them. So the way a futures contract is named is by the year, of course, at the end, January 24th. It's 2024. And then, of course, in the front, we have the contract symbol, which ES, that's the E-mini futures, right? The E-mini. And on TDA, at least, it's ES. There might be something different on your trade station, right? On your trading platform. And then we have this weird code here in between, which is that it's an H, right? So what does that mean? Well, it's right here. This goes way back. I think it probably goes back a whole century. And for some reason, as opposed to A, they're coded generally as F. I have no idea where that comes from, but from then on, it's fairly easy, right? It's F, G, H, J, K, M, N, and then it skips a few letters and it goes to Q and U, V, X, and Z. The most important contracts were always the quarterly contracts. So we're talking about March, which is H. We're talking about June, which is M. U is especially an important contract, U, yeah, September. And then, of course, December, the Z contract. So Z, U, and M, and H, right, were always the most important contract because these were quarterly contracts. And back in the day, that's where most of the activity happened. And when I talk about back in the day, well, honestly, that's until like 10, 15 years ago. In the meantime, a lot has changed. And in the meantime, we've had the emergence of, well, of course, options trading, also derivative, right? A futures contract is a derivative. And all these derivatives have an underlying symbol. So let's say you have an options contract on IBM or Google or whatever it may be, Amazon. Well, that options contract that particular option chain is tied to an underlying. That's the underlying contract. Right? In this case, it's a stock, but it might be a futures contract. And then, right here, these options right here, they go against futures contracts. Okay. So in a way, this is related because what I really want to talk about are not the symbols here. Because right now we're in a March contract, right? If you remember, the quarterlies are always important. So, and if you look right here, the H contract, the H keeps showing up right here on the E-mini, right? So if you're looking back at the chart, you see, we'll move up here, this way. You see up here the H, right? So it's ESH24. So that's the March contract. And before this was the Z contract. See, it goes from September all the way to the end of the year. Okay, clear so far. Now, why do I bring up the whole topic of contracts, of expirations? Well, because in a way, a contract, like a futures contract or an options, right? An option that you buy or sell, it's a bet on the future. What will happen in the future? Will price go up? Will price go down? Goes all the way back to, trading wheat and corn and all this kind of stuff, right? Over a century ago. And well, you kind of wanted to secure price stability. You wanted to know if you grew some corn or whatever it was, or wheat or barley. You want to make sure that, well, you have a certain price by, I don't know, next March, right? You want to be able to sell the stuff. Maybe not March. I don't know. Obviously, I'm not a farmer, right? Maybe by December. Who knows what, right? You harvest the stuff and you want to say, well, prices may drop, prices may go up. I don't know, but, I feel comfortable selling it at this price. So you sold somebody a contract to buy it at this price. And that person, why would they do that? Well, they have similar ideas, right? They say, okay, well, I don't make sure that I'm locking in a good price. It's fairly cheap right now. Might go up. Who knows? Maybe there's a rainy season come. Some witch told me we're going to get a really wet winter, or I don't know. Some birdie told me that all of a sudden some harvest will not work out and there will be fires and who knows what. And so that's how futures contracts kind of came into being. And then options works in a similar way. And I'm not going to get too deep into the topic because we'll be here all day and most of you probably fall asleep. So I want to keep it really focused just on the way of how we view the market and how we can walk away very quickly every day with a really good understanding of what the probabilities are. Okay, so kind of stick with me for now. So with that introduction, futures contracts that are being traded on the market, there's on the trade tab over here, you see these numbers here on the right. Okay, you see these percentages, and I don't know. Some of you probably wonder, what are these percentages? Well, that's actually volatility. And actually, truth be told, these are actually options contracts, okay? This is TDA, so there's a lot of options trading going on. But the topic is similar. So I'm not going to really differentiate between options and futures right now because what I really want to get to is implied volatility, okay? So what is implied volatility? Well, remember when I talked about how futures are being traded and also options and that they're sort of bets in the future? Well, there's always risk because when you make a bet, well, what's the first thing you think about? Well, what's my risk? What's my upside? What's my downside? Okay. If you have a high downside potentially, right? If you could potentially lose a lot of money on your bet, on your prediction, whatever it may be, right? Well, if you want to enter that bet, you're going to ask for more because you're taking on more risk. Well, it's the same when you sell an options contract. And it's the same if you sell a futures contract. Same thing, right? Exactly the same. So futures have volatility associated with it, and so do the options that are potentially traded against that futures contract, okay? Or also options which are traded with an underlying stock, against an underlying stock. Okay, I hope that makes sense. So volatility is really what I'm going to talk about, but not actually realized or real volatility, which is the volatility you see here on the chart, right? So if I'm looking here at the chart, right, and I'm looking at this chart right here, well, there's some periods when price is less volatile, right? And then there's times when price is more volatile, right here. See that? It just pops up really quickly. Now, actually, when you see a move in a particular trend direction, often volatility kind of goes down. So volatility is not exactly a simple subject either. But implied volatility is a little bit more complex because when you look at IV, right, implied volatility, the word that really stands out is implied. Implied means that, well, it's what people think will happen. It's what the consensus of the market has arrived at. it implies that, well, at this point, there's maybe 20, 30% of a chance of markets breaching a particular threshold or something like that, right? So what we're looking at here is basically contract volatility right here for each contract, for each option contract. And if I pop one open here, let's pop up this one here, right? You see right here, this is basically, well, let's take a simple example. Let's go 1 week away, okay? So 1 week from now, so you see two numbers here, 13.71% and 79.9%, okay? It's not moving right now because the market is still closed. Actually, is it moving? Yeah, it's futures market. It's still open. Okay, good. So 13.71%, 79.97%. It just changed a little bit, but you get the idea, right? What does that mean? Well, what that means is actually, this is the volatility that's been derived from trading activity, because you might think, okay, who makes up these numbers? Are there people sitting in a room and just kind of like running formulas and attaching volatility or risk to a particular contract or a particular option chain or futures contract? No, the way it happens is actually, it is a result of trading activity. So all these trades which are being executed all the time, and there's a lot of activity in this. If you compound that together, it's based on standard deviation, right? Standard deviation is basically one standard deviation, right? Let me pop open my drawing tool. I'm going to draw a little graph, and I'm going to try to explain that to you. So in order to explain to you how risk is being assessed, of how risk is being handicapped in the financial markets today, any financial market, we need to talk about normal distribution. And normal distribution, I'm sure you remember, is related to this, the bell curve, right? Right there. Not sure how well I drew this, but you get the idea. Okay? I'm drawing with a mouse, so forgive me if it's not a perfect bell curve. Okay. So what we have right here in the center is the highest probability of something happening. This might be rain patterns, might be growth statistics about a particular country, right? The average height of a person in a particular country, what have you. And in the center, we have the highest probability, and it drops off on the shoulders with like something, okay, maybe let's go back to the example of the average height, right? Maybe here it's 5.11 or 5.10 for men. I think that's probably close to America. It's lower than you think. I thought it would be over 6 foot, but no. In Holland, definitely, I think 6'2" or something. It's crazy. And out here is maybe, 6.5, right? And then down here, maybe we have, 5.3 or something. Who knows? Okay. So, and here in the center, maybe 5.7. Just for example. Okay. And here we have maybe 6 point. My bad. 6.2 or something. Okay. Now, when you're looking at this bell curve right here, okay, this has the same probability out here as this from happening. And this has the same probability of happening as this right here. So we have these ranges, right, from here to here. Right? And if you're looking at these ranges right here, that's what's defined as one standard deviation, one sigma, right? So sigma sign, I don't know if you remember that. It's kind of like this, right? One sigma, right? That's not IQ, that's one sigma. Sorry, it's hard to draw with my mouse. I have a pen, but I never use this damn thing. So I promise you, this means one sigma, and not 10. And here we have 2 sigma, for example, right? Here's 2 sigma. And maybe I should have drawn different numbers. Maybe this is 6.8 here. Maybe this is 5.0 right here. Maybe this is 5.3, okay? You get the idea. And the same here. Maybe this is 6 point, I don't know. This was 6.8 maybe, and this is maybe 6.5, okay? All right, that looks more realistic. So it's very rare to find somebody who's 6.5, 6.6 or even higher, okay? Yeah, I mean, there's people out there who are tall. I've met people who are taller than that, but if you're looking at the average statistics, it's pretty rare. The same thing here. It's, at least among men, very rare to meet somebody who's 5.1, 5.0. It's rare, but you meet people like that in your life, of course. But on average, we're somewhere here, right? We're somewhere between 5.7 with men and 6.2, right? Of course, men always want to be 6 foot, but 6 foot seems to be a little bit here. That's what all men want to be 6 foot tall. Fortunately, I'm 6 foot tall, barely, I made it. So I'm here, but you might be somewhere else. You might be watching this, you might be here, you might be here. But in general, you have a 68% probability of being somewhere here. Right? So on 68%. 68%. Mm-hmm. Now, that's called one standard deviation. Okay? One standard deviation. Now, two standard deviations, we're talking about around 95%. Okay? So odds that you're somewhere between, watching this right now, 6.5 and 5.3 inches, feet tall, not inches. You are in the 95th percentile. It's very high odds that you're this tall. Okay? 95%. So that is 2 standard deviations, 2 sigma. Okay? That's 2 sigma. And 3 sigma goes all the way out. So we're not even going to talk about that. But what I really want you to be focused on is this right here, this space here in the center, the 68%. Right? Right here. Right? 34 up, 34 down. Because this is where all the action happens. Okay? And when we come back to this right here, that's what these numbers represent. Mm-hmm. So when you're looking at this contract right here, this is, for instance, the February contract on the E-mini futures that expires 7 days from now, 1 week from now. Today's Friday, so it expires next Friday. And basically the odds have it that on the ES, on the E-mini futures, we're going to move 79.5 handles, points, up or down, right? Either up or down. We're going to close somewhere between here, in this range, okay? These are the odds. It's based on one standard deviation. And as you move up here, and I'm going to remove this chart here now, so you can see better, the numbers change, right? The numbers get bigger. They don't get bigger linearly, right? They kind of go, if you want to draw it, it starts like this and then it kind of drops off, right? Like this, okay? Why? Well, because when it comes to implied volatility, it's not linear, okay? It's square root of time, and we're going to cover that on a completely different day. Not really important to the discussion today, but you'll see that the numbers get a little bit bigger over time. Because why? Well, more time passes, there's more risk. Of course, it's not exponentially more risk or even linearly more risk. It's a little bit more risk as you go out in time. But focusing just on this contract, that's the risk. That's basically what everything's priced around. And this price is not assessed in a dark room somewhere with people smoking cigars and figuring out this number. It's the product of trading activity right here that's happening right now as we speak, okay? 24/7. It's a futures contract. Or when you're talking about the spiders, then it's 5 days a week. That's when the action happens, and that's when these numbers change. And probabilities change on a constant basis based on new information that becomes available, and then also different people having different opinion about the markets, right? Change their mind. And that's basically how the markets work. Now, the big question you're probably asking by now, after all this dry theory, and we're talking about standard deviation and handicapping risk, what good is it to me? How can I use this in the market? How can I use this right now today to make a better decision as a trader? And that brings me to this, because what you're looking at right here is an indicator I wrote quite a long time ago. And it's basically the expected move indicator. But the expected move indicator is directly related to standard deviation. It's tied directly to these numbers right here. Okay. And actually, this is weekly. So this averages about what this is showing right here. That's why I showed you the weekly contract, because we have around 79 handles up and down, and that's kind of what we'll be seeing right here, right? 79 handles up or down right here for the current trading week. This is actually next trading week. We're in Friday today. So, okay. So this is the center for next week. So if we would close here today, then next week would start right here in the center, and we would assess. Well, if you think about it, right, what does this mean? Well, that's the range for next week, right? Based on based on what we saw right here. This is next week, okay? So this number is not tied to the option contract. I might point this out though, and that's why I started with the futures, because this is actually calculated based on the annualized volatility for each futures contract or for each stock. Because it's impossible for me in my script to go and derive the implied volatility for options contracts. So I use the next best thing, which is close enough usually, which is the implied volatility that you will see when you look at the trade tab and you go down here. I think it's somewhere down here. This is a lot contract, but I don't know. I don't want to pop it up right now, but you'll see the implied volatility for the actually underlying, and that's what it's based on, okay? And it's very related, because as volatility for the underlying rises, the options contracts will rise as well for its expiration, of course. Okay, and now we're really getting to the juicy part, because when you look at this chart right here, you'll see that these ranges change, right? And I'm going to zoom in a little bit here now. Okay, so this is basically the E-mini, right? This is the E-mini futures, and you can see that they are most of the time. We remain each week within this range. You see right here, even right here, right? We dropped through and then closed here, right? And then we opened a week here, and we did close a little bit outside, a little bit. But in most cases, we're staying inside. But then there are periods where price shoots above and breaches beyond the expected move thresholds, right? Again, this is what we call expected move, right? This is the range of the expected move. Expected move because, well, it's expected. It's based on one standard deviation. It's based on distribution. And one sigma, right? That's what everything's priced around, because you need something. You need to have something to base your risk on. You handicap your risk. So you say, okay, odds have it that one standard deviation that 68% that next week price will close here of X. Doesn't matter what it is. And this is what this means. And you can do this on any contract. It could pop up right now. I could pop open Amazon or IBM or what have you, okay? Or Google, and you will see these ranges. And you'll see that in most cases, and let's do that. Let's go to Amazon, okay? And you see a similar thing, right? See right here that it's more volatile. You see right away, right? There's more volatility here in this contract. But most of the time we stay within the range. But then there's times when it pops outside, and that is when turbulence happens in the markets, and that's when you have to be really, really careful, right? Because when these times happen, right, when something does this, right, things go pretty crazy. Now, this is not the best example because it's stock, and stock doesn't trade all the time, so you see these big gaps, right? So that's why I prefer to look at actually something like the E-mini, because the E-mini, right, it's a futures contract, and it trades for much more, outside of trading hours as well, of course, right? So what you see happening here are these breaches, right, outside of the expected move, weekly expected move. So when you're looking at this example right here, you see that we closed right here, and supposedly on Monday we're supposed to open somewhere around near here, right, because we closed on Friday here. And what happens? Boom, we shoot right above it. It's like, whoa, what happened? And we actually closed the day above it. And those are the times when you have to really pay attention, because most people don't look at this. They just look at the price and say, wow, it popped open, okay? And because when something like this happens, then it tells you something about the state of the market. The odds of this continuing is pretty high, because there are other times, right, when we shoot above but then close right back inside. That means that there was rejection, right? And it also has to do a lot with how options market work today. Options markets really drive the stock market, and there's a lot of gamma risk, and I'm not going to explain that today. And when certain thresholds are being breached, market makers are starting to have a problem. So they need to actually start buying contracts against the open positions that they're holding, because they sold retail traders all kinds of options out here, right? Or also down here, right? They sell options down here, they sell options down here, say, yeah, we're good. One standard deviation, we're probably going to stay in here. Well, guess what? We didn't. Now you have a problem. So you're hedging yourself, right? You're hedging yourself. And that's what happens. And that's why when these breaches happen, it's very important to understand that this changes the dynamics fundamentally. And you have to watch what happens around these thresholds, because what happens around these thresholds is really, really, really crucial. you can see what happened here because we just continued higher and higher and higher and higher and higher, right? And then we stabilized a little bit, and then all of a sudden the juice kind of went out. Like, well, what happened here? Here, for a sudden, we stayed above on the upper range of the expected move, but then next week we kind of dropped below and stayed here, and then it catches itself again, and you see this attempt to sell off, but it didn't happen, and boom, it catches itself again, right? And so you can see it here, we closed the week slightly above the expected range. Very close, actually, at the expected range. And then we continue the week here. And it opens basically in the upper range and just kind of works its way up here. So this right here actually looks fairly strong. Okay, I zoomed in a little bit, and we're going to step our way forward here on this Bitcoin chart, on the Bitcoin futures. And let's just look at the price action. And now that you have a better understanding of implied volatility and expected move and standard deviation, a lot of things will start crystallizing in your mind because you will see things that you never saw before, and that was the purpose of this video. So let's start right here. Okay, this is a really good example. You see right here that price stays in a very tight range, and due to that fact, expected move starts shrinking, gets narrower and narrower. Why? Well, think about it. We're moving in a tight range. What's the expectation for next week? We'll be in a tight range again. That's human nature. People always expect to see the same thing that happened in the past, or especially in the recent past. Whenever there's a disaster, people start worrying about these disasters. I remember being in the Northridge quake, and people for months on end couldn't stop talking about earthquakes. Well, they happen rarely, actually, right? Especially twice in a row. Well, there's afterquakes, okay, I know, I've been through them. But you get the idea, right? Or if there's a flood happening, or I don't know, some attack, right? Some, God forbid, terrorist attack. People start worrying about that stuff. So it's human nature that was looking at, the rear mirror and always expect similar things to happen in the near future because it's just how we're wired. And that affects the same here, right? It's the same phenomenon. So I don't know what just happened here. There might be a flaw in the data, but just ignore this for now, right? So you see these ranges, right? And they're very narrow. And price actually stood inside. So what does it tell us? Well, actually risk was fairly well handicapped because anyone who sold options or futures outside here, right, sold your contract, they expected price to stay away from these ranges. And guess what? It did, right? But then something happens, right? Here all of a sudden we see this huge spike. It's fairly big. I mean, think about it, right? The range was really small. We dropped below. Yeah, we dropped below it here, and then boom, all of a sudden we pop higher. That was a big move for that particular day. And then it kind of catches itself, stays outside the expected move though, which is really important actually, and then continues higher. Now think about this again, right? This was the anticipation for this particular week. We opened here, right here actually, we opened higher. I'm sorry, we opened here, my bad. And popped higher, went up, went like, I think this is like 2.5 standard deviations up, and then dropped back down, but closed that day outside of the expected move, right here. And then we stayed outside the entire week. See that? And then what happens after that? Well, look here. Next week, boom, it picks up steam right here. Again, closes the day, opens actually near the center, right, where we left off on the previous day. Actually, the previous trading week, because this is a futures contract that trades on, the U.S. stock market, and so it's not trading 24/7, right? There's periods in between, but anyway, you see 1, 2, 3, 4, 5, right? And again 1, 2, 3, 4, 5, so 5 days a week, and you see that it opens right here, pops up higher, closes here, and next day we don't see a pullback either. It just continues higher and higher and higher and runs away. And so this builds itself. And what happens from here? See, here we stay the entire week in the upper expected move range. Same here. Well, here actually we drop below. So this is interesting because here we actually closed outside, right? But then next week we drop below and kind of meander around. And so there's a little bit of a slowdown, see? It's a little bit slowdown. So things slowing down a little bit. And then all of a sudden, again, here on the last day, boom, right? It takes off. And then continues the next week on Monday right away. And you see these dynamics repeating and repeating. Right? So if you're looking at this price action, right? And this happens all the time. Phenomenon like this, right, where you close the week outside below, and you think, oh my God, the market's gonna fall off the plate, and then the following week, all of a sudden, we open up in the upper range and just continue higher. This tells you a lot about the state of the market. Yeah. For example, right now, where are we right now? Let's read the price action, just based on expected move. We're in the upper range. We talked about this already. We kind of lost a little bit of momentum here. And the question was, are we going to get a correction? Right? And it looked fairly probable that we're going to get a correction because, the range really started compressing. Right? See these candles, they get tinier and tinier each day. There's no trading activity. Maybe that was, I don't know, could have been during, the end of the year, right? It was, I think, early December. So here, all of a sudden, we pop higher again. This funnel spurt, right? And then again, we remain sideways, curling around the expected move, but not going really anywhere. It's kind of like all over the place, right? Here we're kind of below and then above. Then we're here above. The next week we're below. So it's unclear. It's not like it was here. Like, remember here, there was a clear trend. We stayed above until it slowed down. And here, all of a sudden, this is really very important that you understand. And I'm going to zoom in a little bit more, okay? I'll zoom in a little bit more even. Up. I did the opposite of what I promised you. All right, here we go. Oh, no, don't do that. So I'm using all these different drawing tools and charting tools, and each of them work differently. That was confused the hell out of me. So here we are. There was this funnel spurt high. I remember this whole ETF thing with the SEC, and the old rule applied, right? Buy the rumor, sell the news, because as soon as the news were announced and all these ETFs were finally approved, trouble in paradise, right? Look at all this volatility that suddenly comes into the market. Do you see this so much volatility before? No. And when I talk about volatility, I'm not talking about the length of the candle, but look, see these swings, but then we're closing fairly close to where we actually started that particular trading day. We don't see that before very often. We see this maybe here, but this is pretty unidirectional, right? So, at least before, if I scroll back a little bit, okay, if you're looking at this, right, this goes in one direction, right, and you don't see a lot of wicks, the wick of the candle, right here is the wick. They're not very long, they're fairly short, right, in most cases. So that's usually what happens during directional trend. Here, all of a sudden we see these long wicks, right, and then all of a sudden we see this major sell-off right here, boom, and we're closing outside the expected move of the week. And that was kind of the point of recognition because we've obviously slowed down. We tried one more time. There was, the announcement, and then boom, the air completely left the market. And here we have the situation where the next week, right, we actually never even made it into the upper range of the expected move. So that was fairly bad. And here too, we spent basically the entire week now in the lower range of the expected move. And today's Friday, and it's moving upwards, which is good. But the probability of us catching ourselves here and continue higher depend on what happens right here, because we need to make it into this range today, and we need to open here next week. Well, because it's the futures contract. In this range right here, because if we don't, we're probably going to see a correction further downwards, okay? Because if we don't, if we just kind of close inside and maybe even drop lower again, the probabilities of a continuation of this current correction are fairly high, actually. Let me zoom out again. So there you go. So we need to stay up here minimum. It would be nice if we actually closed inside of here, because it's all about the expected move. We're expected to stay within this. If we would have actually dropped below today, below this expected move range, the lower threshold, the odds of us continuing lower next week would have been very high. And what we have now, here's a situation where, well, it's showing signs of life. So there is buying interest. And often during the weekend, it happens on Bitcoin. I don't know why. It seems to be always happening on the last few days of the week, Friday, Saturday, Sunday. So it'll be very interesting to see what happens here, because it will define what happens next. Hey guys, this is Mike from the future. I just want to give you a quick update on what happened the week after. We actually closed Friday outside the expected move range. I don't have the indicator on this chart because it's a trading view, but you can tell by the length of this candle. It continued higher and then closed the week outside. Actually, I think it was inside the expected move range, but pretty near the upper ranges, and then picked up on Monday and continues higher from there. So Pre-bullish, I think the odds of a deeper correction have diminished significantly at this point. And yeah, that's it. So I think it really goes to show how these ranges matter and how they give us important clues as to what happens next on a step-by-step basis. Okay? That's it. And that's how I read the market. This is a really important aspect of what I do, because by just looking at the probabilities, which probabilities? Well, the probabilities right here, which the market gives me, right? This is really, really important for everyone to understand that. Not sure why it's not zooming. It's supposed to. Right here. So this right here, this range tells me everything I need to know about the market. See how it got rejected down here? This was very important that we got rejected down here, because had it closed out here, most likely we would have probably continued lower right there, right then, and probably cascaded down. Here we have a situation where it's kind of catching itself. This is looking good, but this is really positive now. And this needs to continue, and we need to open here next week and stay in the upper range. And in that case, I would say, okay, the probabilities are pretty high that will continue higher. If it just meanders around again, we could see a pullback again, and we still see the big correction that maybe brings us down to, I don't know, 36K, even 35K. It's very much possible. Okay, I will conclude the video with this. In the future, when I show you this chart, you will have a much better understanding of what I'm talking about, why expected move matters, while these ranges matter, and how they all relate to probability. And I give you a pretty good idea of what's going on in the marketplace right now and what the odds are of a particular move either continuing or reversing. Okay? So before you leave, don't forget to hit the subscribe button, maybe hit that bell, and I'll see you all next time. Cheers.